All right, so welcome back to our second video of TIKRBUDDY. I'm here with Foolish Investor, and he did a great job breaking down the first part, talking about analyst estimates. And now we're going to get into stock valuation calculators, and he's going to help break that down for us. So the first thing we said, we want this to be for beginners.
Yep.
We definitely have to break down when it's appropriate to use the PE, and just to go back. So we had the analyst estimates. So this is where we actually punch in numbers and come up with our evaluation or our DCF, right?
Yep. Yeah, definitely. So you could go to the analyst estimates, or you can come straight here, right? Because you still get given the analyst estimates. They're here anyway. It's just that on this page, you only get the ones that are relevant to performing the calculation. So for the PE, you don't need all the growth. You just need revenue, EPS, net income, and shares outstanding. Like I said, our long-term aim is to hopefully have explainers. So if you were here, like you could hover over a little question mark sign and get like an explanation of what's what. But yeah, we can do a quick explanation of what each of these methods are. So we start with the PE calculator. So this is kind of one of the most classic ways, I guess, to value a company is to say what's the so if you're looking at today, for example, so one way I guess value investors might value a stock is they'll look at Apple and they'll say it's a 17 PE. So it's trading at 17 times its earnings. So if it's earning $1 billion, it's trading at $17 billion. It's trading at 17 times its earnings. Similar companies right now trade for like 10, so this stock is overvalued. I've never liked that thing because I've always believed and that a stock's value should be based on what it's going to do in the future. I don't
Right.
really care like what the multiple is right now compared to this, that, the other. If Apple's got a 17 earnings multiple, but it's going to grow 3 times faster than everyone else, then that's kind of a moot point. So what we're doing is obviously you need to figure out what earnings are going to be, let's say 5 years from now. And then you want to make an estimation of what kind of an earnings multiple should the company trade for based on all of that 5 years from now. And then we're using that to obviously find the value of the company today. So I'll do a PE valuation. So we're doing I guess not a DCF, we're just doing a PE. We're basing it off its estimated EPS in 5 years and what we think the multiple will be. And it's just for any company that is going to be profitable by 2026. So you just look at these estimates, and if you can see that it is going to be profitable, then you can reasonably make an assumption of what kind of a multiple to that earnings per share is going to trade for, right?
So here, so what would you put a PE multiple for 2026 here?
So let's say this is one of the other features that I think could be useful to show now. So again, because I know when it comes to P multiples, it's not the easiest thing to do. That's why we've incorporated, as you can see, the stock comparison feature. So what you do there is you can click on the edit symbol next to Enphase. And let's say you want to put in SolarEdge, for example, right? A similar company. Now, this is for you to do with your own discretion, obviously, but you got to think of what are the most comparable companies. And then you can now have a look and see, okay, this company, so SolarEdge trades for around, I don't know what the P is there, a 34 times PE, for example. You can compare the revenue growth to see, like, should these companies be similar? So if, for example, so look, if you can see SolarEdge is trading at a 34 PE right now, right?
Right.
And if you go down to revenue growth, there isn't that much different. You have to decide, like, is the justification there for Enphase to trade almost double when revenue growth is pretty much the same?
Okay. So then would you do the 34 to match
So
Solar Edge, or what would you do
I,
here?
I would definitely think it needs a bit more. I would have to spend a little bit more time analyzing the companies and looking at the growth. But I really like Peter Lynch's method. So this is something that Peter Lynch did, where he looked at. So if you look at 2023 to 2026, right, you can see growth roughly is around 18 to 20%.
Mm-hmm.
And I really like his method. I mean, the earnings growth. So EPS is growing at around, if you average it out, even though it works out to about probably 17 to 20%. And I really like Peter Lynch's method of basically earnings P multiple should equal the growth rate or somewhere close to it. So I'd probably be more comfortable somewhere like a 20. But I think this is something that you have to definitely spend a bit of time on, and that you can't just make that decision like with a snap of your fingers.
Okay. So we'll go with 20, and then discount rate, you said you would go with 12.
12, yeah.
Obviously, we put the disclaimer, a lot more research before you
Yep.
come up with the multiple. and then we calculate, and then it gives us the fair value of $89, current
Mhm.
price 292. It's a 225% difference, and the target for 2026 is $158.
Yeah.
So this is possibly overvalued, probably too
Yeah,
expensive.
so it
Oh,
kind of gives you an idea of like, oh, that means this stock would have to trade at a 40 PE multiple to be a fair value in 2026. So you kind of then that makes me more uncomfortable. Like when I know that a stock has to trade at like 40 times its earnings to be give me returns, if you get what I mean.
yeah, yeah, absolutely. So just to recap, we said we would use the PE calculator for what type of companies or
So
sector?
companies that are profitable. I mean, generally, most of these valuation methods will work for most companies, maybe not companies in the finance space, so banks and stuff. But besides that, as long as the company is profitable, you can definitely use the PE calculator.
Good. Okay, so let's move to the next one, and then here we have the DCF calculator.
Yep.
And when would this one be appropriate?
So again, if the company is cash flow positive, some people would say only if the company's cash flow is reliable. Again, that's your decision to make on what you want to do. But I mean, if you've got analyst estimates showing cash flow positivity for all these 5 years, I would use the DCF.
Okay. And then do you have any insight? What kind of research would you do to come up with the
Yeah, I would do
EBITDA
the same thing. So I like to look at the growth of the EBITDA as one, and then I like to look at the stock comparison and compare similar companies, whether they're directly similar from sectors. Also, sometimes just if I can't find that, then companies in similar in terms of profit margins and growth rates. So if a company has a similar profit margin and growth rate, what does it tend to trade for? And I like to try and find companies that are a couple of years more ahead of where my company is. So I can say that, okay, when this company gets to that level, what kind of a multiple should it trade for? But yeah, you could look at, obviously there's so many companies you could look at and see. There you get the EV to EBITDA there on the stock comparison tool, and then just have a look and see what works best.
So based off this limited information and quick, what kind of
Yeah.
multiple would you give?
I would be comfortable with around a 25 to 30, 25. Yeah.
25. And we stick with the 12%, right?
Yeah.
And so we have here, just break down MPV.
So that's obviously the net present value. So you're taking all the cash flow, what all that cash flow is worth today. You want to obviously make the adjustments for cash and debt so that you're figuring out, okay, this is what the company has now, and you get to your equity value. Once you have that, you're just dividing by shares outstanding, just so that you know, okay, what's this one single share worth? Because with the DCF, you're valuing the entire business. So I had comments in the past on my YouTube channel when I was doing DCFs, and people say, oh, you didn't account for share dilution. The DCF obviously is valuing the whole business. As I think that's something that you should bear in mind. That's where it differs from PE and all of that. You're valuing the entire business as a whole. And then you're just kind of, okay, let me now just divide that value by the amount of shares there are today, so I know what each share is worth. So yeah, share
Okay.
dilution is irrelevant in a DCF.
Getting the whole enterprise value, right?
Yeah.
So then it gives you the cash, the debt, equity value,
Yep.
and then the shares outstanding, right?
Yeah. So one thing I think that's really good about DCF, I think if you use DCF regularly, it starts to train your brain, like how Warren Buffett says, treat a company like you're buying when you buy a stock, behave like you're buying the whole business. I think a
Right.
DCF can kind of help you kind of train yourself to do that as well.
Good, good. Okay, so then the next one is the EBITDA calculator. And when would this one be appropriate?
So I think okay. So firstly, like if you're like me, I like EBITDA versus EPS. That's just my personal preference. So you might be one of like that, or it might be that your company is not net income profitable, but is EBITDA profitable because of things like the depreciation, amortization, interest payments. So then you might want to use the EBITDA calculation. What we do here is we kind of break it down to a per share. So we work out the EBITDA, then we work out EBITDA per share by assuming the dilution at the company, and then we do the valuation based on that.
So you're just assuming, okay, maybe this company on paper doesn't show that it's too profitable, but they have a lot of potential.
Yep.
One, they're going to take care of their debt, they're going to take care of all these other things, and then
Mhm.
they're going to show their profit.
Yeah, exactly. So if you look at the history of Amazon, for example, and again, gets into the more higher risk side where you have to know more of what you're doing. But when you look at the history of Amazon, they were not net income profitable for
Right.
so many years. But if you had a tracked their EBITDA margins and you looked at what kind of EBITDA they were posting, it was absolutely insane. And based on that, you could have really made a good calculation that this company is going to be highly profitable at some point in time.
Okay, so good, great. You explained that well about EBITDA when it's appropriate to use it, and
Yeah.
Amazon was a great example for sure, for sure.
Mhm.
Anybody who kept an eye on that could have made a ton of money.
Yeah, say 25, like we said earlier on the DCF.
And then if you were going to assume share dilution, how would that affect this number?
Because so how the calculator works is that because the EBITDA is already filled in from analyst, so we only need to know EBITDA. But oh no, actually it will change. So yeah, so sorry, if you had assumed share dilution, it would basically reduce the EBITDA per share.
Okay.
So which would mean then that you would need a higher multiple to get to the price you're trying to get to. So if you've got, as you can see here, you've got 682 million estimated EBITDA in 2022, for example, that's been divided by 142 million shares. So that'll be a certain amount of EBITDA. But if you were then to say it's going to be 200 million shares because of dilution, the EBITDA would be much lower, which would then obviously make your price target lower when you add the multiple to it.
Yeah. Okay. And then the last one is price to sell calculator.
Yeah. So
Now,
I'll give you my honest opinion. It's like this is the most useless one of everything, but it's there because people will want to use it. But in my opinion, price to sales is I wouldn't want to say useless, but I think it's a pretty as bad a valuation metric as you can get. Just because price of sales doesn't factor in so many different things. I mean, some people will look at a company and say, oh, it trades at 10 price of sales, so this one should too, but this one has an 80% gross margin and this one has a 10% gross margin. So when you look at price of sales, you tend to ignore all of that. But it's there for you, I mean, if you want to use it. And that would only be in the case of a company that has no profits, no positive EBITDA, no positive cash flow, and the only positive thing is revenue.
okay.
Is the only time you'd use the price of sales.
Would you consider also putting in a calculator for a person that wants to calculate like market share? So like for example, you calculate that this company is going to take 5% of market share by whatever year. It can just do the math for you.
Yeah, I would love to do all of that kind of stuff because I'm really like into finding ways to project. I love projecting revenue. It's something I love doing personally. And I love doing different methods of like estimating the market share. Or like when you do electric vehicle companies, like okay, how many electric cars will be sold? How many share will this company have? And I love doing all of that. I would love to
Yeah.
include stuff like that. Yeah.
Yeah, because like I played around. I tried to, this is
Yeah.
before the
Yeah.
dilution. This is an old
Yeah.
Tesla
Yeah.
DCF, and just playing around. I
Yeah.
did autonomous assumptions,
Yeah.
electric vehicle, also their ride health assumptions, and I
Yeah.
based it kind of like on what Uber was making, I guess, and
Mhm.
just playing around. It's kind of fun.
Yeah.
Insurance assumptions if they do sell
Yeah.
insurance.
Yeah. Yeah.
So being able to add all those things.
Definitely. The closest thing that we've got to building kind of thing is so far. I mean, we'll talk about it in another video, I think, but we did the build a model page, which is going to be for the people that are a bit more advanced.
Okay. And so we'll close here. Next video, we'll talk about building a model, some of the settings, some of the Discord, and how you can sign up for TickRBuddy. If you like this product so far, click on the link below. We have TickRBuddy. You get a 7-day free trial, working out some sort of discount, and I think you'll enjoy it. You'll get to play with it for free, 7 days, test all the companies that you're already invested in or potentially want to be invested in, and just see if you're getting in too early, too late, if it's overvalued. And we also have another link for Magic Mind. I take this stuff every day. It helps with focus and concentration. If you're interested in any of those products, just click the link below. Thank you.